Today, we delve into a complex and often controversial topic: how U.S. politicians navigate the world of finance, specifically concerning insider trading. The potential for conflicts of interest is significant, given their access to non-public information and their ability to influence policies that can directly affect company valuations. Insider trading involves buying or selling securities based on material, non-public information, granting an unfair advantage over other investors. To address this, the Stop Trading on Congressional Knowledge Act, or STOCK Act, was enacted in 2012. This act prohibits the use of non-public information for private profit by members of Congress and other government employees. It also mandates public disclosure of financial transactions involving stocks, bonds, and other securities within 30 days. Despite its intentions, the STOCK Act faces significant criticism regarding its effectiveness. One major concern is the weak penalties. A violation can incur a fine as low as $200, which is hardly a deterrent for potential large profits. Furthermore, there's a notable lack of enforcement, with no member of Congress successfully prosecuted for insider trading under the STOCK Act. Reporting delays also allow weeks to pass before transactions are disclosed, potentially obscuring timely scrutiny. Additionally, family loopholes may permit relatives to make trades on behalf of politicians, bypassing direct accountability. The Ethics in Government Act of 1978 also requires members of Congress to disclose their financial reports, adding another layer of transparency. The 2020 congressional insider trading scandal brought these issues to the forefront. Several senators were investigated for selling stocks just before the COVID-19 pandemic-induced market crash, allegedly using knowledge from closed Senate meetings. Senator Richard Burr, then chair of the Senate Intelligence Committee, sold hundreds of thousands of dollars in stocks after receiving private daily briefings on the coronavirus. Senator Kelly Loeffler and her husband also sold millions in stocks following a private Senate briefing on COVID-19 in January 2020. Similarly, Senator Dianne Feinstein's husband sold biotech stocks worth millions after a closed-door Senate Health Committee briefing. Senator Jim Inhofe also sold stocks in January 2020 after a Senate briefing on the coronavirus. Representative Spencer Bachus bought options, betting the markets would fall after a closed-door briefing by the Treasury Secretary and Federal Reserve Chairman. Arguments against politicians trading stocks highlight the inherent conflict of interest due to their access to market-moving information. Such activities can erode public trust and accountability, creating an unfair advantage over the general public. Conversely, some argue that elected officials should retain the right to control their personal investments and retirement funds. They point to existing ethics reviews and divestment requirements as sufficient safeguards. Furthermore, market knowledge is considered crucial for securing future retirement. Proposed solutions include outright bans on stock trading for members of Congress, their spouses, and dependent children. Another reform suggests requiring politicians to place their holdings in qualified blind trusts, managed by independent trustees. Encouraging divestment of publicly traded stocks upon taking office is also a key proposal. Strengthening enforcement by granting subpoena power to the Office of Congressional Conduct could lead to more rigorous ethics rule enforcement. The debate over politicians profiting from insider trading remains active, with the STOCK Act being a step towards transparency, albeit with limitations. Ultimately, reforms aim to restore public trust and ensure lawmakers prioritize constituents' interests over personal financial gain. Welcome back. Let's look at real-world cases where politicians' actions have caused a stir, examining the controversies surrounding stock trading by those in power. The central issue revolves around whether lawmakers, who possess privileged insights into market-moving information, should be allowed to participate directly in those markets. One notable example involves Representative Rob Bresnahan, a Republican from Pennsylvania, who has made over 600 trades since taking office. Some of these trades coincided with votes and legislation that favored his investments, raising significant questions about potential conflicts of interest. For instance, he sold bonds tied to local hospitals after voting for Medicaid cuts, a move many critics deemed profiting from insider information. This specific instance sparked public outrage, highlighting the tension between public service and private financial interests. Another prominent case involves Senator Dianne Feinstein, who invested in healthcare stocks just before the market crash. This occurred when the public learned about the devastating impact of COVID-19, leading many to question the timing of her investments. Critics pointed to the suspicious timing of these investments, suggesting she might have acted on non-public information. Although investigations were conducted, the Justice Department ultimately dropped its inquiry into Feinstein's trades. Despite these actions causing public outrage, there have been no successful prosecutions under the Stock Act so far. The Stock Act, or Stop Trading on Congressional Knowledge Act of 2012, was designed to combat insider trading by members of Congress and other government employees. It prohibits the use of non-public information for private profit and requires members of Congress to publicly disclose financial transactions within 45 days. However, the Stock Act has faced criticism for its weak enforcement and lenient penalties, which many argue undermine its original intent. The penalty for failing to report a financial transaction is a mere $200, which is hardly a deterrent given the potential for substantial profits. Indeed, no member of Congress has ever been prosecuted for insider trading under the Stock Act, raising serious questions about accountability. Calls for reform have grown louder, with many legislators pushing for a total ban on stock trading by members of Congress. Proposed solutions include requiring members to place their assets in blind trusts or divest their holdings altogether. Several bipartisan bills have been introduced to address the issue, such as the Ending Trading and Holdings in Congressional Stocks, or Ethics Act. Another significant proposal is the Ban Congressional Stock Trading Act, aiming to eliminate conflicts of interest and restore public trust. These bills aim to prevent members of Congress, their spouses, and dependent children from owning or trading individual stocks. Despite the ongoing debate and proposed legislation, the issue remains contentious, with concerns about internal resistance and political risks. Some argue that banning stock trading would unduly restrict the financial freedoms of elected officials, while others maintain that it is a necessary step to ensure public trust and ethical governance. This ongoing debate highlights the tension between public trust and private financial interests in government. To stay informed and advocate for transparency, individuals can monitor financial disclosures of politicians. They can also support organizations pushing for reforms and engage with elected officials to express their concerns. So what can you do? Stay informed, follow disclosures, and support transparency reforms. Thanks for watching. If you found this enlightening, like and subscribe, and let us know what financial topic you'd like us to explore in the future.